Hello everybody, today we are going to study module 4. In this module, theories, capital asset pricing model and portfolio performance measure. In this module, it has three topics covered. First one is theories in which Dow Jones Theory, alloyed waves theory and efficient market theory. Next topic is capital asset pricing model. In this topic, the subtopics are assumption of CAPM equation, capital market line and security market line. Now, number third is portfolio measurement performance. In this topic, the subtopics are meaning of portfolio evaluation, Sharpe's ratio, Tenures ratio. So this is all overall concept of this module. All topics covered in this module. So first one is Dow Jones Theory. So what is the Dow Jones Theory? Dow Jones Theory is the Dow theory has always been a very integral part of technical analysis. So it is related with the technical analysis. The Dow theory was used extensively even before the Western world discovered candlestick. Candlestick, this I told you in module 3 in detailed manner. In fact, even today, Dow theory concepts are being used. In fact, traders blend the best practices from candlesticks and Dow theory. The Dow theory was introduced to the world by Charles H. Dow, who also founded the Dow Jones Financial News Service. That is in Wall Street Journal. This news service is Wall Street Journal. During his time, he wrote a series of articles starting from the 1900s, which in the later years was referred to as Dow theory. Much credit goes to William P. Hamilton, who compiled these article relevant example over a period of 27 years. Much has changed since the times of Charles Dow, and hence there are supporters and critics of the Dow theory. Now, next topic is how the Dow theory works. There are six main components to the Dow theory. First one is the market discounts everything. The Dow theory operates on the efficient markets hypothesis that we call in a short form EMH, which I will tell you in third theory, that which states that asset price incorporate all available information. In other words, this approach is analysis of behavioral economics, earning potential, competitive advantage, management competence. All these factors and more are priced into the market, even if not every individual knows all or any of these details. So in this point, in more restrict readings of this theory, even future events are discounted in the form of risk. Now, second point is there are three primary kinds of market trends. Market experience, in which primary trends which last year or more, such a bull or bear market. Bull or bear market. Within these broader trends, they experience secondary trends, often working against the primary trend, such a pullback within a bull market or a rally within a bear market. These secondary trends last from 3 weeks to 3 months. So, finally, there are minor trends lasting less than 3 weeks, which are largely noise. Now, third one is primary trends. So, in this subtopic, there are 3 phases. Primary trends have 3 phases. A primary trend will pass through 3 phases according to the Dow theory. In a bull market, there are accumulation phases, the public participation or big move phase and the access phase. Next is in a bear market, they are called the distribution phase. The public participation phase and the panic or disappear phase. So all about three phases. Dow theory suggests the market are made up of three distinct phases which are self-repeating, and these are called accumulation phase. In next phase, that is the markup phase and the distribution phase. So the accumulation phase actually occurs right after a steep sell-off in the market. The steep sell-off in the market would have frustrated many market participants, losing hope of any uptrend in prices. So the stock prices would have plummeted to rock bottom valuation, but buyers would still be hesitant to buy, fearing another sell-off. Hence the stock price languishes at low levels. This is when the smart money enters the market. Now, what is the smart money? A smart money is usually the institutional investors who invest in a long-term perspective. The investor who invests in a long-term perspective, that is a smart money. They invariably seek value investment which are available after a steep sell-off. Institutional investors start to acquire shares regularly in large quantities over an extended period of time. This is what makes an accumulation phase. This is what makes up an accumulation phase. This also means that the sellers trying to sell during the accumulation phase will easily find buyers, and therefore prices do not decline further. Hence, invariably, the accumulation phase market the bottom of the markets. More often than not, this is how the support levels are created. Accumulation phase can last up to several months. Once the institutional investor, that is a smart money, because in a smart money I told you already, the smart money means the investor who invest for a long-term perspectives. So once the institutional investor absorb all the available stocks, short-term traders sense the support. This usually coincides with the improved business sentiment. These factors tend to take the stock price higher. This is called the markup phase. So first is accumulation phase is done, markup phase is done, now third phase. So before that, what it is a markup phase happen. During the markup phase, the stock price rallies quickly and sharply. The most important feature of markup phase is speed, because the rally is quick. The public at large is left out of the rally. New investors are mesmerized by the return, and everyone from analysis to public sees higher level ahead. So finally, when the stock price reaches new heights, 52 weeks high, all-time high, everyone around would be talking about the stock market. The news reports turn optimistic. Business environment suddenly appears vibrant, and everyone, that is public, wants to invest in the market. The news reports turn optimistic. Business environment suddenly appears vibrant, and everyone, public, want to invest in the markets. By and large, the public wants to get involved in the markets as there is positive sentiment. So this is when the distribution phase occurs. So this is all about how Dow Jones Theory works. Now next is Elliott wave theory, second theory. In this theory, it is also called modern theory or 21st century market. So what is the Elliott theory? Elliott wave theory is named after Ralph Nelson Elliott, 28 July 1871 till 15 January 1948. He was an American accountant and author. Inspired by the Dow Jones Theory and by observation found throughout nature, Eliot concluded that the movement of the stock market could be predicted by observing and identifying a repetitive pattern of waves. So he observed that repetitive pattern of wave. Now Eliot was able to analyze market in greater depth, identifying the specific characteristics of wave patterns and making detailed market prediction based on the patterns. Eliot based his work on the Dow theory. So it is actually based on Dow theory, which also defines price movements in terms of waves. But Eliot discovered the fractal nature of market action. Eliot first published his theory of the market patterns in the book titled The Wave Principle in 1938. Now, next topic is basic principle of the 1930s Eliot wave theory. Simply put, movement in the direction of trend is unfolding in 5 waves called motive wave, while any correction against the trend is in 3 waves called corrective wave. So there are 2 waves, motive wave and corrective wave. The movement in the direction of trend is labeled as 1, 2, 3, 4 and 5. The 3 wave correction is labeled as A, B and C. These patterns can be seen in long-term as well as short-term charts. Ideally, smaller patterns can be identified within bigger patterns. In this sense, Eliot waves are like a piece of broccoli, where the smaller piece is broken off from the bigger piece does in fact look like the big piece. This information about smaller patterns fitting into bigger patterns, coupled with the Fibonacci relationship between the waves, offers a trader a level of anticipation and, or you can say, prediction against searching for and identifying trading opportunity with solid reward risk ratios. Now, the 5 waves pattern, motive and corrective. In Eliot model, market prices alternate between an impulsive or motive phase and a corrective phase on all time scales of trend. Impulses are always subdivided into 5 lower degree waves, alternating again between motive and corrective character, so that 1 and 3rd number and 5th number waves are impulses, and wave 2 and 4 are smaller retraces of wave 1 and 3. In figure, this wave 1 and 3 and 5 are motive waves, and they are subdivided into smaller degree impulses labeled as 1st, 2nd, 3rd, 4th and 5th. Wave 2 and 4 are corrective waves, and they are subdivided into 3 smaller degree waves labeled as A, B, C. The 5 waves move in wave 1, 2, 3, 4 and 5 make up a large degree motive wave. Corrective waves subdivided into 3 small degree waves denoted as capital A, B, C. Corrective waves start with a 5 wave counter trend impulse wave A, counter trend impulse wave A retrace wave B and another impulse wave C. The 3 waves A, B and C make up a large degree corrective wave 2. So basically in a bear market, the dominant trend is downward, so the pattern is reversed. 5 waves down and 3 up. So this is all about Eliot wave theory. Now next theory is this efficient market theory. The efficient market hypothesis is a central idea of a modern finance that has profound implications, and understanding of the efficient market hypothesis will help to ask the right questions and save from a lot of confusion that dominates popular thinking in finance. An efficient market is one in which the market price of a security is an unbiased estimate of its intrinsic value. Note that market efficiency does not imply that the market price equals intrinsic value at every point in time. A corollary is that investor will also be less likely to discover great bargains and thereby earn extraordinary high rates of returns. The requirements for a security market to be efficient markets are: prices must be efficient so that new invention and better product will cause a firm securities prices to rise and motivate investor to supply capital to the firm, that is, buy its stock. Information must be discussed freely and quickly across the nations so all investors can react to new information. Next is transaction cost, such as sales commission on securities are ignored. Taxes are assumed to have no noticeable effect on investment policy. Every investor is allowed to borrow or lend at the same rate. And finally, next is investor must be rational and able to recognize efficient assets and that they will want to invest money where it is needed most, that is, in the assets with relatively high returns. So this is all about efficient market. Now, next topic is forms of efficient market hypothesis. Iguana Pharma suggested that it is useful to distinguish three levels of market efficiencies, and they are: first one, weak form efficiency. Weak form efficiency, prices reflect all information found in the record of past and volumes. Now, next is semi-strong form efficiency. In this, prices reflect not only all information found in the record of past prices and volumes, but also all other publicly available information. And the last one is strong form efficiencies. Prices reflect all available information, public as well as private. Now, next topic is forms of efficient market hypothesis. Iguana Pharma suggested that it is useful to distinguish three levels of market efficiencies, and they are: first one, weak form efficiency. Weak form efficiency, prices reflect all information found in the record of past and volumes. Now, next is semi-strong form efficiency. In this, prices reflect not only all information found in the record of past prices and volumes, but also all other publicly available information. And the last one is strong form efficiencies. Prices reflect all available information, public as well as private. Now, next topic is capital asset pricing model. In short form, we can say CAPM. So, the capital asset pricing model CAPM is used in finance to determine a theoretically appropriate rate of interest of an asset. If that asset is to be added to an already well-diversified portfolio, given that asset non-diversifiable risk. The CAPM formula takes into account the asset sensitivity to non-diversifiable risk, and that is also known as systematic risk or market risk that I already told you in module 2, referred to as beta in the financial industries, as well as the expected return of the market and the expected return of a theoretical risk-free asset. The model was introduced by Jack Trenior, William Sharps, John Linkner, and Jen Mosin independently, building on the earlier work of Harry Markowitz on diversification and modern portfolio theory. Now, next topic is assumption of CAPM. CAPM is an equilibrium model of the trade-off between expected portfolio return and unavoidable risk. There are following assumption of CAPM. Now, first assumption is capital markets are efficient where investors are well informed. Second one is transaction costs to market investment in different securities are zero. Next is there are negligible restriction on investment and no taxes. Next, the situation of market is alike perfect competition and no investor is large enough to efficient the market. No investor is large enough to affect the market price of the stock. The capital asset pricing model is all about describes individually stock returns as a function of the overall market returns. The capital asset pricing model, that is CAPM, is a model that describes the relationship between the expected return and risk of investors in security. It shows that expected return on a security is equal to risk-free return plus risk premium, which is based on the beta of that security. Below is an illustration of CAPM concept. You can see this diagram. Now, next topic is undervalued and overvalued stock. The CAPM model can be practically used to buy, sell or hold stocks. CAPM provides the required rate of return on a stock after considering the risk involved in an investment. Based on current market price or any other judgmental factors, that is known as benchmarks, one can identify as to what would be the expected return over a period of time. By comparing the required return with the expected return, the following investment decisions are available. So in the first case, when CAPM less than expected return, we need to take a decision buy. This is due to the stock being undervalued, that is the stock gives more return than what it should give. In the next condition, that is second condition, when CAPM greater than expected return, we need to take a decision sell. This is due to the stock being overvalued, that is the stock gives less return than what it should give. And the third condition is when CAPM is equal to expected return. In that the condition, we need to take a decision to hold. This is due to the stock being correctly valued, that is the stock gives same return than what it should give. From another angle, if the current market price is considered as basis of CAPM, then actual market price less than CAPM, stock is undervalued. Second condition, actual market price greater than CAPM, stock is overvalued. Actual market price is equal to CAPM, stock is correctly valued.